What if I told you that Bitcoin didn't just stumble, it got hit by 6 different trucks at the same time? Buckle up, because what's happening in crypto right now is either the end of the party or the best buying opportunity you'll see in years. And the difference between those two outcomes is understanding exactly why we're here. Let's start with the most predictable culprit, the multi-year cycle. Traders who've been in this game since 2017 know that roughly every 4 years, smart money quietly walks out the back door, while retail investors are still cheering at the front. And that's almost certainly what profit-taking looks like when Bitcoin peaks and suddenly just starts drifting. Now, layer on top of that a phenomenon nobody in crypto wants to admit: capital is flirting with other speculative assets. AI stocks and precious metals have been flashing like a neon sign saying, "Come, spend your risk appetite here." And when money has options, crypto has to compete for attention like everyone else at the party. Then came October 10th, a weekend shock that hit like a cold bucket of water on a sleeping market. Weekend liquidity is already thin, so when concentrated selling pressure landed on a Saturday, there was nothing to absorb it, and the cascade looked far worse than the fundamentals deserved: classic illiquidity theater. Meanwhile, whispers about Fed policy under a potential new nominee sent a chill through every risk asset on the board. If the next Fed chair is hawkish, think higher for longer on interest rates, then the cost of holding speculative assets goes up, and suddenly that Bitcoin position feels a little less exciting compared to a 5% treasury yield sitting right there doing nothing. Here's the one that genuinely made the community anxious in a way that rate hikes never quite did quantum computing. The fear is that a sufficiently powerful quantum machine could theoretically crack Bitcoin's cryptographic foundation, which sounds like science fiction until you remember that people said the same thing about a lot of things that eventually became Tuesday. Let's be honest though, quantum risk to Bitcoin is probably overstated right now, because the timeline for cryptographically relevant quantum computers is still measured in years or decades, and the Bitcoin protocol can and likely will be upgraded long before that threat becomes existential. Misconceptions like this create panic selling, which is actually just opportunity wearing a scary costume. The 6th driver is the broadest and most boring: a general risk-off move across global markets. When institutional investors get nervous about macro conditions, they don't discriminate. They sell equities, they sell crypto, they sell anything that isn't nailed to the floor. And Bitcoin, despite all the digital gold branding, still gets treated like a growth asset when fear walks in the room. Look at history and you'll see this pattern wearing different clothes every single time. 2017, 2018, 2021, 2022, each correction felt unique. Each one had its own villain, and each one eventually resolved in a way that made the sellers look foolish and the patient holders look like geniuses. The lesson isn't that it always goes up. The lesson is that panic is almost never the right analytical framework. The practical checklist here is actually pretty simple. Watch Fed nominations like a hawk. Monitor quantum computing legislative and research developments. Track whether capital rotation into AI and metals is accelerating or reversing, and pay close attention to weekend liquidity conditions before sizing into any position. None of these are crystal balls, but they're the actual levers, not vibes, not Twitter sentiment, not your group chat. What separates the people who build wealth through cycles from the people who just have stories about almost wealth is process, position size, and patience, not conviction, not timing, not being the smartest person in the room. You can be completely right about Bitcoin's long-term trajectory and still blow yourself up by sizing in too heavy at the wrong moment, which is the financial equivalent of being right for the wrong reasons. Philosophically, the market doesn't owe you a clean entry point, a tidy narrative, or even basic fairness, and that's the part nobody puts on their vision board. The discipline of showing up with a consistent, unemotional strategy when everything feels chaotic is the actual edge. And honestly, we should all be a little more comfortable saying, I don't know exactly when, but I know how I'll respond when. 6 drivers, 1 correction, a dozen lessons, and a roadmap forward. And if any of this has you thinking about where else to put your money to work across real estate, contracting projects, or finding the right lender, check out our links in the description below, and let's help you get started.